Perfect. Okay, hello. We are today with Bill Scotting. He's the CEO of First Team, and the stocks can't stop going up. And today we are having a conversation to talk a little bit about the team market, supply, demand, and also a little bit of First Team specific questions that I have. Okay, so hey Bill, how you doing?
Very well, thank you, Hugo. Nice to speak to you. And as you said, the market's red hot at the moment.
Yeah. How are you seeing the current fly-ups we are seeing in Sin? Recently, it went up almost to 58K in price. What's your view on that?
Yeah, look, for me, it's not unexpected. I think we're in the middle of a structural change. The supply for tin has not really grown for over 10 years. There's been ebbs and flows from different locations around the world. Myanmar came up, Indonesia came up, then the DRC came up, but equally Myanmar went down, Indonesia went down. So if you take a 10-year look, the supply hasn't really grown. And the genesis of this goes back even further to the 1980s when the Tin Council collapsed, the tin price collapsed, exploration and development collapsed, and now you've got the situation where demand is really growing. We've got a structural change in demand with the advanced manufacturing, the use of solder, everything electronics, so data centers, the solar, EVs, everything digital, all the advanced manufacturing uses, they require solder, which today is predominantly tin. There's not really a substitute for that. So demand is steadily growing. I think the process of miniaturization, which happened for about 20 years, is gone. Now we're into all the AI applications that's requiring, again, bigger graphics interfaces. That's going to require more tin, the data centers, and so on. So demand is just steadily going along. You don't need aggressive assumptions on that, but the existing producers are maxed out. And you look at the locations, there are significant, let's say, geopolitical and social risks in a lot of those locations. So there's steady outages, and that puts you in fly up territory when you have limited inventory globally, the demand there. You've got, let's say, some financial players coming in, and you're well into fly up territory now, and that's what's driving the tin price at this point in time.
Yeah, completely agree. But it's interesting, it has just coincided with a little bit of a recovery in Myanmar and Indonesia, like these fly-ups. But we are still far away from the average of what those countries used to produce. What's your view mainly on Myanmar and Indonesia, on the restrictions Indonesia is putting on illegal mining, but they are also increasing the quota for legal mining?
Yep. Yeah, look, it's difficult to forecast exactly what they're going to do. I think the key point is, as you said, Indonesia is a long way down from its peak, and it's hard to see it going back to that peak anytime soon. The government is trying to regulate. There are environmental problems. There are the problems of regulation, illegality, and so on. So the government is doing that. So that has brought it down. Um, and the movement from some of the alluvial, the dredging, those sort of things which are impacting the environment, there'll be, I suspect, some sort of recovery will come through in Indonesia as they try to get to grips with it. Myanmar's a different situation. It's been, a couple of years now out of action, and the volumes have really collapsed in the Wa province. It's been mooted to restart for over a year now. People have been talking about it, and it kept getting delayed. There has been some movement now. I read that there was some supply going into China in the last month, so it is starting to get going again. I think the major shift there is it's going to go more underground, so that's going to make it more difficult
Mm.
to get the volumes back. And I think the other thing is we tend to think of it as a mine, but it's not. It's many individual players in that environment. You've had the compounding factor of the situation with trying to get to grips with the scam centres, the drugs, on the border, the government forces, compounded by the recent earthquake, which just makes things more difficult. So again, I think it will start to come back, but it's a long way to get back to where it was. And in the meantime, the tin demand is steadily growing. Solar, I was reading today, is around 20% of solar use today. And if you go back 10 years, solar was very small, and it's a major consumer of tin. It will continue to grow. And then you've got all the electronics, EVs, all the driver aids, all of this going into not just EVs, but all vehicles. That requires electronics, requires more solar. So the demand is just growing. And there's no new tin mines. People tell me we'll be the next new tin mine, but we're probably early 2028 at the earliest before we'd be in production. So there's a bit of a gap to fill, and I think that's part of the issue. Inventory is very low on the LME in Shanghai, and that's the situation we face today in tin.
Yeah, I agree, but I struggle a little bit to understand the problem around not having enough new mines or new junior miner projects, because I understand the drag from the international international tin council, that caused tons of years without exploration, but what's stopping new companies and new miners now to start a new exploration process? How much would it take to start from exploration to PFS to DFS and having the mine ready? Oh, is that similar to copper, that it can be over a decade?
It's over a decade. If you look at, for example, our two developments, these are in historic tin areas. Taronga, which is our most advanced mine, it was originally drilled 100 years ago. BHP, Newmont, about 50 years ago. It went into abeyance after the collapse after the second oil shock in the 80s. The mine was then picked up. There was a little bit of exploration. We've been involved there for about 5 years now, and we've done more drilling work there. But then you get into a lot of the exploration. There's a lot of exploration now happening, but you've got to do a lot of drilling. You've got to take the resources through, from inferred, measured, and indicated into reserves. You've got to do your economic studies. That requires time. It requires testing of the material to work on the processing plant before you can develop your pre-feasibility studies, your definitive feasibility studies, and then there's permitting. And today, permitting takes a long time. We submitted our permit in Taronga in the back end of last year, and that was the culmination of, I'd say, at least 3 years of detailed studies. So you're talking a lot of studies on everything from the geology, the soil, the air, the noise, the dust, traffic, impacts on the local community. It's many years of work and studies which are required by the authorities these days. So it takes, I think across the globe, I think the average is about 17 years to bring a mine through. Now that's all mining, not tin mining specific. And that reflects the requirements today. And that's why it's going to take time for new mines to come to fruition.
Yeah, okay. And understand that. And in terms of extraction cost, are you seeing that new projects, new exploration are estimating much higher extraction cost, and around what range are those costs?
Yeah, so if I think about the tin cost curve, it's clear, and I was looking at some data from the International Tin Association, their supply curves, and what you have is generally there's a little bit of inflation which is driving up cash costs. all-in sustaining costs through the cost curve. But what you're seeing now is, as you're trying to keep up with demand, as your average grades are declining, the costs are creeping up. But more importantly, there seems to be a separation of what I call the 90th percentile on the cost curve from the average. So the cost curve is getting steeper. It's getting steeper at the margin, and that implies higher prices going forward. It also implies the inducement price for new capacity will be higher going forward as well. And this is, again, it's a structural thing. You're in a situation where you're at the far end of the cost curve, and you've got to bring in new capacity. To get new capacity, to get the investment, you need prices which will cover the inducement costs, including capital, and that's what's also behind the structural increase in prices.
Yeah, what I see really interesting in the tin sector, because I've been invested in PGMs for 2025 and late 2024, it has done pretty well, and the setup in terms of supply, it's really similar. You have really concentrated supply in a really unstable area. But the good thing with tin is that demand is forecasted to grow at strong rates, and therefore, as you said, in the even marginal players need to make money in order for supply to grow. And at what price of tin are you seeing that 90 percentage point of the curve?
Yeah, I think today you're looking at somewhere at least around 30,000 US dollars today. I think you can look at, there's very few listed producers out there giving costs, but if you think about Andrade, who are one of the smaller producers growing, then you look at their results, their all-in sustaining costs are in the mid to high 20s at the moment. So I'd suggest when you get to the more marginal, it's going to be higher, and that's where I suspect the marginal players are sitting today.
Okay,
That's cash and all-in sustaining costs. To get inducement, you've also got to get the capital costs covered for the new, and that goes in. And then, as I said, you're in a situation where there isn't supply, so you're into the fly-up situations, which take it even higher.
Metal sex, if I am correct, it's around 22,000 USD. Metal sex, okay. And after looking at some projects, yours, Elementos, and the other ones that are listed, it seems like the 25 to 30K $1,000 range is where you make like 15 to 20% internal rate of return. You a little bit above that, as you have lower capex. But what's stopping over the long term to basically reduce a lot and stabilize that 90% point at a lower price, meaning that long-term average price of tin could be lower? Do you think that's as a possible outcome, or is there something that could create the opposite, higher long-term average prices?
Yeah, it's a very good question when you come to long-term averages, and the way I always look at that is, you've got, firstly, what have you got to take to induce new supply, right? And that comes for the long run. And we're in a situation where you need a number starting with a 3 at least, and moving up to get that there. So that's already a good base to think about that long-term supply. And the thing with generally commodities, you get those swings, you get tightness, the price goes up, and then you get a flood of new capacity coming on with a delay, and then the cost curve drops down again. But I think if you look at tin, you've got just this steady growth of demand, which is pulling it. And then you look at the number of mining projects out there and the time horizon to bring them on. So you don't see a big flood of new supply coming. Sorry, the Apple Watch there. you don't see that sudden flood, which would see the cost curve kick down again. And you are, over time, going into always the easy stuff gets dug out first. So as time
Yeah.
goes on, you're going to more difficult. A lot of the new projects are underground. The cost base is higher, the risks are higher as well with those.
Yeah, and I assume also the WACC used to calculate the returns on projects on Myanmar and Indonesia, it's much higher than the rest of the world.
Theoretically, that should be the case. I mean, we've used 8%
Yeah,
on Taronga for the DFS, and you mentioned, our margins. I mean, the DFS is 2 years old. We're updating it now. We hope to extend the mine life in the update, and also other improvements. We'll put a slightly higher tin price through there. But there will be some inflation in the last 2 years. There always is. But at a 30,000 tin price, you're talking about a 50% margin.
yeah,
On all-in sustaining costs, and a nice internal rate of return for that. And you look where tin prices are today; it just goes up. These projects are highly leveraged to tin price.
yeah, completely agree. And looking at that pipeline of projects, you also have some projects on Europe. How are you thinking about, because I guess your short-term priority is Taronga, and how are you looking into developing those projects once you have Taronga?
Yeah, look, I think we've got the best pipeline of projects in the industry. Taronga is clearly the focus. It's the most advanced. We're waiting on permitting at the moment. We look for the financing at the same time. It's possible that the first half of this year will be permitted, financed, DFS published, and moving ahead. Then you look at our pipeline beyond Taronga. So we have Tellerhäuser,
Yeah.
which was the original genesis of this company in southeast Germany, in Saxor. It would be an underground mine, polymetallic. It has actually a PFS, which was produced around the time of the IPO. It is another attractive project. The polymetallic, so the byproducts of magnetite, zinc, indium, a bit of copper, silver in there as well. And we're also finding other critical minerals like germanium in there. So we want to do a bit more drilling there, finish off the DFS, and then we either get other funding coming in, which will allow that to go, or we can recycle some cash flow down the road. So there are various development pathways for Gottersburg, for Tellerhäuser. Next off, around Taronga, it's a historic tin area. We have 750 square kilometres of exploration licenses around the old Emerville Tin District. And we have a exploration pipeline there, and we see a lot of potential for down the road permitting a little hub and spoke system around the Taronga processing plant. So that won't be just a 10 to 15 year mine around Taronga. It's potentially a long-term tin district. Then in Germany, we have Gottersburg, which is another attractive deposit, which is near to Tellerhäuser. And then in Australia, again, we have an exploration license over the Taronga tin field, which is about 70 kilometres southwest from Emerville. And that's another historic tin field in Australia, which is not really being drilled out, but in the 1800s had a lot of mining. Some very rich seams were mined there. So that's what I call a Horizon 3 opportunity.
Yeah.
And then back in Germany, we have Auersberg, which is between Gottersburg and Tellerhäuser, contiguous with both. That again is a long-dated opportunity, has a nice long strike length there. Interesting hits, again, polymetallic, indium, germanium, gallium through there. So I think we've got the We've got the largest OECD tin resource, 367,000 tonnes. It's the largest in the OECD, and it's a 10-year plus developmental horizon to go after. And with tin demand, I read today that tin demand will double by 2050. Believe that if you will. The growth is there anyway, with all the electronics and the uses, but there'll be a requirement for new mines, and we've got a great portfolio to go after.
Great. Before going a little bit deep into that, I would like to ask about recycling, because some people cite this as a key point of concern. According to what I have researched, when you recycle the PCBs and other electronic materials, you are really taking and recycling tons of metals, tons of rare earths. So it's not really that reactive to just tin price. It's more of a group of metals. But it's true that most rare earths are at pretty high prices right now. Do you expect a big response from the recycling side?
Yeah, look, the recycled tin is roughly, let's say, 25% of the market, and it's steady there. It will keep growing, but it's hard to see that being the game changer to meet tin demand. If you think about, sorry, the Apple Watch again, let me throw it over there. If you think about the PCB, the cars from electronics, right? You're talking very, very small amounts of tin in that. And if you go into recycling, how you can recover that, they've got to be dismantled, they've got to be shredded, they've got to go through processing, you've got to separate out the gold, silver, PGMs, rare earths, tin. It's not an inexpensive process to get there. It's not going to change the game with tin. The volumes will probably creep up over time. So I see the share staying in the mid 20s. And if you look at some other metals, that tends to be the case. There are exceptions, but in the main, it takes time to build up that recycling. Part of it, you've got to get the stuff from the consumers into a recycling system. And that is easier said than done. You can look across Europe, which I'm sure you've looked at. You can look at the differences in the US. You can look at places like Australia. There's a lot of infrastructure to be built out there.
Yeah, that's true. I understand it. Then we can go a little bit into the demand, because I would like to understand mainly the exposure this has to the AI capex super cycle we are seeing, because I am not sure about you, but I think it's a little bit not to discredit anyone, but probably it will not continue at this pace for forever. So is tin at risk if we see the acceleration of AI capex, for example, data centers and semiconductors?
Yeah, look, I think the good thing about tin is the demand is not reliant on any one sector. Just over 50% goes into solder. That solder, roughly a fifth of that is going into solar, and solar's been on a great run. Nothing grows exponentially forever, ever, but it's got a good runway of growth still to come with the solar ribbons and so on. There's that. Then you've got the EVs, right? Now, there's some pushback in some locations on the EVs, but the die is cast there. It is growing. I always discount the automotive sector's growth numbers anyway, but the EVs are growing. So if you just think there's 1.2 kilos of tin per EV compared to, let's say, 400 grams in an ICE, so that has value. Then, as I mentioned earlier, in general, in automotive, all the drive aids, all the electronics, that are coming into new cars, right? That's more electronics. That's more tin. You can't have the electronics without tin. You need the solder for the connector to make the electrons flow. So that's another growth vector. Then you've got all, you talked about AI. I was reading about computers where people are going to be using AI, the requirements for that. They are in general requiring 10% more tin because they're bigger. So the whole miniaturization is getting reversed. People are looking for bigger graphics interfaces and like. So that's another just ongoing growth sector. Then there's just all the consumer electronics that we use, and these things have a shelf life, and we keep using more and more. So there's a variety of uses driving that. Then you can go into other things. Batteries still required. I'm not the expert, but there's a lot of research on how tin is being used in batteries, and there's opportunities there. Then you've got glass manufacturing, the Pilkington process, the plate glass. There's a lot of buildings out there, all these high rises using glass, right? Doesn't have to grow much, but it goes along there, just keeps going. So you've got all these different things. Alloys, tin is still used in all different alloys, right? So all these multiple sectors, they're growing. And as I said, I don't use aggressive numbers. I think of tin as a late cycle metal, whereas coking coal, iron ore, a more early cycle, in the big cycle. So, typically late cycle will grow for many years around about the GDP level. But even if it lags that a little bit, it's not like a mature steel cycle, which can lag GDP. So there's just, I think, steady growth going to come for tin.
Yeah. Also, if you think so, tin demand is really tied to uh, emerging markets, we can say, because there will be a lot of people entering the middle class, and all of these people start to buy. Like, they didn't have a mobile phone a decade ago. Now they have a mobile phone, a microwave. They have 10 times more things that require tin. So that's a very good also argument about tin demand. Okay, so and last question here on the supply demand, a little bit on how do they interact. I always like to look at past cycles to understand what could go wrong. For example, in 2021, we had a similar move of tin than the one we saw today, like a little bit more than 2x. Why it's different now than in 2021?
Yeah, I think the difference is in 2021, you had the post-COVID shock. So post-COVID or with COVID, you had a shock on the supply chain. So that really hurt. And also you had a bit of a demand shock with people using a lot more electronics because they're sitting at home and so on. So you had a mini cyclical effect there. And that's what drove it up. That supply chain got stuck, the supply was short, the price flies up. Why it reversed? It basically reversed with the situation in Ukraine, and all the metals went in reverse. The supply shortage coming from the COVID time worked its way through the system, and you had that correction. But if you look at the last 3 years, tin, out of all the base metals, has been the outperformer. And why has that been? It went down like everyone else, but it's continued to go up ever since, steadily. I think it bottomed out at 18,000, moved up to the mid-20s, then 30s, low 30s. A couple of times, I think, speculating traders tested the bottom. The floor was about 28 in 2024. And it bounced back, and it's just kept creeping up. As it got tighter and tighter, you can see the inventory started to run down again, and then it's driven up. So it's truly, for me, a structural issue. There was, that structural issue got temporarily brought forward because of the COVID discontinuity back in, 3 or 4 years ago. And once that worked it way through, we're now in this situation.
Okay, I understand that. And do you think right now there's a little bit of speculation in tin just because it's a metal and the rest of the metals are going up?
Yeah. Look, I think in these, particularly today, I'm not a how can you say it, a financial investor in metals, but I look at what's happening, and with the geopolitical uncertainties at the moment, there are investors out there looking at where they can get returns at this point in time. And I think metals are one place they can do it. The dollar's weakening, that always is or tends to be good for metal prices. And then you look across the metal complex, and as I said, from a pure supply demand structural situation, I believe tin is the best out there.
Yeah, completely
People
agree.
talk about lithium, they talk about rare earths. Each of these has issues. Lithium, there's a lot of hard rock available. It had a big price peak a couple of years ago, but the supply is there. You look at rare earths, the problem's less about supply from mines, it's about a processing issue. So, you can look at all the different metals and think about what's driving the situation. And in tin, it's a real structural lack of supply overlaid with that demand characteristic, which makes it so attractive at this point.
Yeah, and inventories are so small, are so thin. Why is that happening? Because like in commodities, you usually have like 6 months of inventory or three quarters. What in teams we have like weeks. It's measured in weeks.
That's the illustration of the structural problem. You go back again in history, back to the 1980s, there was probably a couple 100,000 tons of inventory because that's how they managed it back then. Once the thing collapsed, the US had a massive strategic stockpile. They ran that down over 20 years. It's not there. And you've gradually over time, you went through the demand, the miniaturization that went through, the demand is creeping up. The supply, as I said, hasn't grown for 10 years. So the inventory's been steadily running down. There's ebbs and flows, but it's trended down, and you've got to the stage, the inventory's not there. And until you get new supply, you can't rebuild inventory.
Yeah.
That's the issue.
That's right. I mean, you need to gap the deficit, and then you also need to purchase half of year of inventory to balance the market, which is something that not a lot of people take into consideration. You need actually a surplus, a decent surplus to balance this market.
Yeah.
Okay. Especially, with China, Myanmar, those type of players in the market.
Yep.
Okay, so now let's go a little bit more to talk about first in a specific. Okay, you already talked us through the core assets you have and your strategy. And so let's talk a little bit about Taronga. What's the main milestones now to look to get Taronga into production, and how are you thinking about that?
Okay, there's really 3 milestones now. We submitted the environmental impact statement back end of last year. We received the response from the authorities on their questions for clarification. We are working through those requirements at the moment. We will submit those. I'm hopeful we'll have the permit in the second quarter of this year, for 2026. That's what I'm looking at, hoping for. You can never prejudge what the authorities might do, but I don't see anything that would necessarily negate that. The second thing is the work to update the DFS, which we published 2 years ago. And a key part of that, we did a 10,000 meter drilling program, infill and extension drilling program last year. That finished at the back end of last year. We have the assay results back from that, which basically confirmed the geological interpretations, confirmed our expectations. Those assays are now in the hands of the resource geologist, who is updating the resources, and I anticipate quite a bit of conversion of inferred into measured and indicated, which means we can take them into account, redesign the pit shells for deeper, wider, longer pits, which would allow us to extend the life of mine down the road. And an extension of life of mine from the current 10 years to 12 to 15 years gives us a lot of value, because it's just the current pits would just go a bit deeper. That would be that extension would of course be permitted down the road. It's not something we do immediately, because we just take the pits down, and as you're getting down to ready to do it, then you do the permitting work, which is basically an extension of I think the waste rock emplacements would have to be a bit bigger. So no major change there, but that's worth, at a 30,000 tin price, that life of mine extension was worth about another 100 million Aussie dollars of pre-tax NPV. The other thing which will improve the NPV is we've been doing a lot of work on the processing, looking at the crushing, look at the jigs, the spirals and so on, looking to, prove a bit more recovery, but also looking at optimizing the specification of the concentrate that we will sell, which optimizes the payability that we get. So all of that work could be another, 30 to 50 million of NPV pre-tax from that metallurgical processing work. And then on top of that, of course, we'll update the tin price. We use 30,000, which today looks very conservative. I'll do the maths, but for example, every 1,000 US dollars is about 25 million Australian dollars, or let's say 18 million US dollars on the NPV. So I know some of our competitors in the course of last year were using 34,000. So for example, if I used a 34,000, that's another 100 million Aussie dollars on the NPV. So we'll publish that. That work will be done. We'll update all the CapEx costs. We'll update the OpEx, publish that, and that will also be due in the second quarter of this year. And then the third piece of work is on the financing, the project financing. And we announced last year that we had a letter of interest from Exim Bank, potential 120 million US dollar project financing paid back over 12 years, related to sending offtake to the US. So we're in the process of discussions with them, with the offtaker, to see what financing that would provide as against alternative financing. So those are the three main things. They should all come together in Q2, which will allow hopefully a final investment decision by the end of Q2.
Great. And in terms of financing, I assume with that letter of intent, you are thinking about doing full debt in terms of financing, or you are thinking about diluting?
No, always with these, there'll always be an element of equity for the project financing. The beauty of what the Exim are offering is, with the offtake, is potentially a very high proportion of debt. But we haven't got to term sheet with them at this stage. So it's hard to say what that would look like. There are other financing, for working capital, which would be debt of some sort as well. So, we'll do what is optimal from a capital structure and look to maximize the value for shareholders as we do that.
Great. Because you need near 100 60 million Aussie dollars or something like that?
It was 176 million Aussie dollars, so around about at the time 116 million US. I anticipate that'll go up because it's two
Yeah,
years since then. So just on a nominal basis, that'll go up, but it's still a very low capex
yeah.
development, and that's because it's open pit and a very simple processing plant.
Okay, understand that. And maybe this is a little bit sensitive, but MetalX has been pretty vocal about their intention of trying to buy First In once they get the permitting. Uh, what theoretically, what exit multiple would investors expect, or something that will be reasonable comparing to other projects and other transactions in the mining sectors for a permitting project such as First Thing?
Yeah. Look, I can't comment on what Metals X are doing. You know, what I can say about Metals X, they're 29.9% shareholder. They're a very supportive shareholder. They know the sector. You know, there is speculation about what they'll do. I don't know. All I can do is take our project forward and look to deliver value for the shareholders. What I can tell you is I think they've publicly said they like Taronga. They've also publicly said, Brett has said that he's been to Germany, which he has. I've taken him to Germany. He thinks it's a very good project. So we have two very good projects at a 40,000 tin price, so still quite some way from the 55,000 we are today. Taronga's NPV is of the order of 650 million Aussie dollars based on the DFS, right? Assuming the life of mine extension. That pre-tax NPV, that is about 330 million pounds. We have 541 million shares outstanding. So you can do the maths on that in terms of, in theory, what it's worth pre-tax. You know, that's about all I can say at this point in time. I think we've got a great project with a lot of value. The share price is starting to recognize some of the value. We need the permit, we need the finance, then you go into production, and these are the de-risking and re-rating steps that are typical for a mining project. And if someone comes in, of course, you're expecting a premium at each of those stages.
Okay, understand that. And then some last questions. Um, what are the management incentives that are set up in First Team? What do you have set options?
Yeah. Okay. In First 10, and this is public, at this stage, we don't have any options for the management. I came in just over 2 years ago when the company was right at the bottom. So I didn't think it was appropriate at that stage. We agreed a salary, which I thought was right for the stage of development of the company and where it is. I put some of my own money in, so I benefit as a shareholder. And of course, I bought in. I backed my view. Before I joined, I did my own research on tin. I liked it structurally. I think it's the best metal out there. And I put some of my own money in, so I'll benefit as a shareholder with what's been happening now. This year we are putting in place a bonus system for the key management, reflecting that we've started to recruit people, and to recruit the people for the project, you've got to be at the market, and the market requires that you do that. So we are starting to put in place that incentive system as we bring new people in. We will revisit the question of long-term incentives over the course of the year.
Okay, great to hear that. Great to hear that, and great that you made some great money with the recent rise.
Yeah, like I said, I think tin is structurally the best metal out there. I believe that. I tell people, I remember iron ore 20 years ago. Tin's tiny compared to iron ore, but iron ore went through a structural change at the start of the 2000s when Chinese demand took off, and the major players, which were BHP, Rio and Vale at the time, had 70% of the market, couldn't keep up, and it required a whole new supply to come in. The cost curve steepened. The iron ore price went from about $26 to around $150, and it stayed, north of 100 most of the time since. I look at tin, it wasn't three companies, it was three countries, China, Indonesia, and Myanmar. Supply couldn't keep up. The demand shock is all the electronics, solar, these things. So you had a different demand shock, supply constraint. So, like I said, I think structurally it's a great story, tin, unrecognized, the hidden gem, as people say.
Yeah, great to hear that. And as a last question, I think lots of investors do not understand a lot of geology and about mines. So could you make a very simple explanation of what's the geology of the Taronga project?
Yep. Okay. I'm hand up. I'm not a geologist either, right? But what is unique about Taronga and what drives the value? Point one, it'll be open pit, so the ore body outcrops at the surface, right? So it just comes up. It's on the side of the hill, comes up. So when you walk over it, you stub your toe on the ore, right? It's right there on the surface. So there's very, very low pre-stripping before you start mining. That's the first thing. Second thing is the strip ratio is 1:1. When you go underground, which a lot of tin mines do, then your strip ratio starts to climb 4:1, 5:1, out to 10:1. So this thing outcrops at the surface, low pre-stripping, so quickly into your ore body, 1:1 strip ratio, which is highly valuable. The second thing about it is the mineralogy. The tin comes in subvertical veins. So you have the host rock, which is, metamorphic, and there are these subvertical veins of quartz through the host rock. And the tin is in that quartz vein. And that quartz vein is much softer than the host rock, which is a hornfels. And there's no tin through the hornfels. So when you crush it, it fractures along those veins, which allows us to get rid of the waste rock very quickly. So it upgrades very fast through the crushing, through the jigs, and the gravity separation. So it's a very, very simple processing circuit. Doesn't require multiple floats or anything like that. We don't need ore sorting, so the capex and opex of ore sorting, because there's no tin in that hornfels. And that's what makes it unique. And at the end, we have a very simple, small sulfide float and dressing circuit. And that's what makes Taronga's value. Open pit, simple mineralogy, simple processing, low capex. All the kit, there's no fancy kit. It's really basic, low tech crushing, jigs, spirals.
Great to hear that. I think it's a really clear explanation. Thanks, Bill, for taking the time to speak with me and to update us on this great opportunity, and hope to talk soon.
Great. Thanks very much for your time, Hugo. All the best. And long may tin continue doing what it's doing.
Yeah.